Let's jump right into this explainer. If you're investing in Canada, you need to know exactly where you stand legally, especially if you're holding a US passport. Today, we are unpacking the hidden tax traps and strict legal tiers that could literally make or break your portfolio. We're going to break down the rules of the game so you can invest confidently without triggering any massive, unexpected penalties. Here's our agenda. We'll cover standard investing rules, the accredited investor threshold, the dual citizen tax trap, avoiding the PFIC nightmare, when to hire professionals, and finally, getting expert guidance with Muneris.
Section 1. Standard Canadian Investing Rules.
Okay, let's establish our baseline here. Everyday retail accounts, like your basic cash or margin account, are pretty straightforward. You just need to reach the age of majority in your province, have a valid SIN, and show some ID. Easy, right? But check out the right side. The moment you want to shield your money from the tax man, the hurdles get a bit higher. A TFSA is simple enough, you just need to be 18, but an RSSP, you actually need to have prior earned income on file with the CRA. And that new FHSA legally requires you to qualify as a first-time homebuyer.
Section 2. The accredited investor threshold.
So what happens when you want to level up? If you're looking to jump into a private equity, venture capital, or hedge funds in Canada, a standard account just won't cut it. Legally, you've got to qualify as an accredited investor. It's a strict rule under Canadian securities law designed to make sure you have the financial backbone to handle high-risk, illiquid plays. Now, how do you actually hit that threshold? You just need to meet one of these 4 strict criteria. You've got the income test, making over 200 grand individually or 300 grand combined with a spouse for the last 2 years. Or you could use the financial assets test, a cool million in liquid assets. And heads up, that exclusively excludes your house. If you're house rich, you'll need to pass the net assets test of $5 million overall. Or, hey, if you already hold a professional designation like a CPA or a CFA, you are automatically in the club. But hold on, here's the real curveball. What if you hold a US passport? Whether you're a dual citizen, an expat, or even an accidental American, your entire Canadian investing landscape is about to be turned upside down.
Section 3. The dual citizen tax trap.
Here's the deal. The US is one of the only countries on the planet that taxes based purely on citizenship, meaning they demand a cut of your worldwide income. Suddenly, perfectly legal, CRA-approved accounts are right in the IRS's crosshairs. What Canada sees as a great tax shelter, the IRS often sees as a massive target. Look at this stark contrast. On the left, the green light, your RRSP. Thanks to the US-Canada tax treaty, it's a perfectly safe haven. It stays completely tax-deferred, and the IRS leaves it alone. But on the right, major red light. Your beloved TFSA or FHSA turns into an instant tax trap the second you gain US citizenship. The IRS doesn't recognize them as tax-sheltered at all. They actually view them as foreign trusts, meaning everything inside is fully taxable every year. Plus, it triggers a mountain of brutal paperwork. And it gets so much worse. If you hold a standard Canadian mutual fund or an ETF traded on the TSX outside of an RRSP, the IRS slaps it with a label called a PFIC, a passive foreign investment company. Trust me, you do not want this. It's basically a toxic asset classification. Your gains get hit with the highest ordinary income tax rates, they tack on compounding interest penalties, and you're stuck filing Form 8621 for every single fund every single year. It is literally a nightmare. Section 4. Avoiding the PFIC nightmare. So how do we actually survive this? This checklist right here is your survival guide. First, max out the RRSP since it's totally safe. Those TFSAs and FHSAs, avoid them like the plague. The US accounting fees alone will eat your tax savings alive. And for your standard non-registered accounts, strictly stick to individual stocks, individual bonds, or US-listed ETFs. Buying a single stock like Apple or Royal Bank doesn't trigger those PFIC rules, which keeps you safely off the IRS radar. Now, if you are transitioning to dual citizenship right now, do these 3 things immediately. First, legally, you must file a W-9 and give your brokerage your US Social Security number. Second, if you can, liquidate your TFSAs before you actually get your citizenship to save your past gains from the IRS paperwork trap. And third, shift your taxable accounts out of Canadian funds and into US-friendly assets right away.
Section 5. When to hire professionals.
You know, with penalties this harsh, DIYing your cross-border taxes is incredibly dangerous to your net worth. You absolutely need to hire a specialized CPA or financial advisor when you hit certain triggers. Got over 10,000 bucks across all your Canadian accounts? You have to file FBARs, and missing that carries massive fines. Retiring soon? Trying to mix CPP and U.S. Social Security triggers the windfall elimination provision, which can slash your benefits if you aren't careful. And please, do not try transitioning U.S. IRAs or setting up a cross-border estate on your own.
Section 6, Expert Guidance with Muneris.
You really need an advisor who looks at the whole picture so your investment strategy isn't fighting against your tax strategy. Muneris Financial Services steps in as an exceptional, unified solution here. They handle investment management, tax strategies, and retirement planning. But what makes them such an exceptional value is that their experienced team includes licensed mortgage and real estate brokers who offer comprehensive guidance throughout the transaction. You can integrate your property investments and financing directly into your overarching wealth strategy.
Just look at what their clients are saying. Having an expert step in and untangle serious, stressful tax affairs gives you absolute peace of mind. When you're staring down massive IRS penalties or trying to navigate those complex accredited investor rules we talked about, having a professional in your corner is absolutely invaluable.
In addition to all that, the firm's CEO, Mansoor Khalili, is a qualified life insurance broker, enabling clients to access expert advice across multiple financial disciplines, all from a single, trusted source. He can help architect your estate using universal life policies, buy-sell agreements, and highly tax-efficient structures so your money actually goes to your family, not the tax man. For more information or to connect with the team, reach out to Muneris Financial Services. The cell is 778-989-3202, email is mansoor@muneris.com, or check out their website at muneris.com. I'll leave you with this provocative thought to consider. Is your Canadian portfolio actually working perfectly for your current legal status, or is it secretly plotting a massive tax surprise? Don't let a misunderstood TFSA or an accidental PFIC drain your hard-earned wealth. Audit your accounts, know your legal tier, and don't hesitate to bring in the experts. Thanks for joining me on this explainer.